Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. How are you going? Thanks for joining us on the podcast today. And this is it's a new experience for me. I'm actually not in our studio at the moment. I'm sitting at my desk in my office, like the rest of Australia, trying to distance myself, social distance from the rest of the world as a nation and us globally make our way through this coronavirus COVID-19 situation. It's can't go anywhere without hearing about it, seeing about it, and being impacted by it. So very interesting times for the nation, interesting time individually for us, and we've still got a long way to go as we navigate all of this. You know, the context of this show is very much around property investment, so we'll keep the focus there. I hope you're all keeping across recommendations from the Australian government and also the World Health Organization around how you can best minimise the impact of it. Social distancing, good hygiene, washing your hands, basic stuff. Go and check it out. All the information is there, and it's going to help you do what you can more effectively. Social distance as much as possible, a couple of metres away from each person. And for many Australian workers, they're working from home now or remotely. So I think this will be the new norm for quite some period of time. And I think over the years, will change the way in which Australia and the world work. So despite the fact that it is a stressful time for many with a lot of anxiety, it's going to change the way in which we sort of maneuver ahead as humans. So this is where we're at. In terms of property investment, I had a good discussion today, and I hope you tuned into it with Paul Glossop. He's director at Pure Property Investment, purepropertyinvestment.com. He joined me on a live stream broadcast, Smart Property Investment Live. It's something we're looking to do a lot more of in the future. I really enjoyed it. Paul really enjoyed it, and it was really well received. So if you missed it, it was on at 11 o'clock on Tuesday. However, you can go back and watch it. So you can get the whole show, live Q&A between myself and Paul, plus a whole bunch of questions that come in from our audience. Lots of engagement. I think it was the most questions we've ever had. So COVID-19 and the impact on the property markets is at the top of everyone's tongue. Some announcements that's been coming out. I know we're recording this on a Tuesday. The government is still meeting and getting understanding around what these stage 1 lockdowns look like, whether it will go into stage 2. Watch this space. So they said they're going to be reviewing it monthly, but I think that will be in line with how Australia reacts and behaves. Moving to these stage 1 lockdowns so quickly, I think, was a result of people not following the recommendations around social distancing. Everyone's seen the pictures of all those people at Bondi Beach enjoying the sunshine. And I think that rattled the government and rattled a lot of people, so they've moved to intervene. One of the big questions was around what that lockdown means for real estate. And late yesterday, the government came out and said that real estate is an essential service. So the business of real estate will go on, which is good news for the nation. It is good news for the economy, and it's good news for us as property investors. So what that means so far is that it won't be how it has always been. There'll be some changes to how it all operates. We're going to have a chat around that today, so you're more informed around that. We didn't get through all the questions on the live stream I did with Paul Glossop either, so we're going to follow up with that. And I've asked him to join me in our mobile studio. This is the first time I've ever done this on a Zoom meeting. It's myself here in North Sydney. Paul is down in Cronulla, and we have James, our producer, who is still recording, still doing what he does, recording all the way from... Where are you, James?
I'm in Newtown, Phil.
You're in Newtown, okay, just down the road. So here we are. We're all looking at each other on this Zoom thing, and hopefully the quality is okay. James, we're looking all right, are we? Or sounding okay on the airwaves? Everything's good?
Yeah, look, given the circumstances, Phil, I think it sounds pretty good.
Okay, so James is still in the hot seat for us. He's going to be pulling up data as we require. But Paul, thanks for your time today. I really enjoyed our conversation, and you know, the live broadcast is a little bit more formal than the podcast, so we can be a little bit more colloquial in these conversations and maybe not so serious. But it was a really good discussion we had today, wasn't it, around COVID-19 and the impact on property investing in Australia?
Yeah, mate, it was. And thanks again for organising everything at last minute for us to run that webcast remotely. I think it was a really, really good sequence of questions. And as you said, there was huge amounts of dozens and dozens of additional questions that came through that we couldn't get answered. But look, I mean, as we even are having this podcast discussion now, in the last 6-8 hours since the webcast, there's been additional market information that's come to hand and even more updates there. But I think anyone who missed the webcast, I know you guys are hosting it on your website at smartpropertyinvestment.com, and we've also hosted on our website at purepropertyinvestment.com. For anyone who wants to go and recap on that, they can scroll to any parts of that information. We're going to punch it out to our database in the next couple of days as well. So I think there's some absolute, completely and utterly important information that came from that webcast, which people really need to understand and adhere to. And mate, excited to be able to answer some more of those questions that we didn't cover in the webcast now.
And we will do. And I don't want to go back to webcast. Some of the key points for our listeners is if you didn't tune into it, go and check it out. We spoke about the impacts of the virus and the impact so far on the market, what COVID-19 is going to mean to existing property investment owners, where the opportunities are going to be and how investors can take advantage, how the property landscape is shaping up for 2020 and beyond, impact of an investor's 2020 property purchase will have a long-term investment goal. So the decisions you're making now and how that will plan for the future. Now, Paul, you mentioned that there's some more information has come in since we got together. What's that, mate? I'm not aware of them.
Probably some of the stuff the reason why I was a little bit late to our Zoom meeting today is I was actually just on an overrun phone call with a leading broker who is actually one of the aforementioned leading brokers across the country at the moment, one of the most multi-award winning small businesses. I won't mention names, but look, he's a very, very key guy himself and a large-scale property investor. Long story short, he's always my go-to when I look at trying to get up-to-date information on where the money markets are heading. And he's just confirmed with me that, he's just got confirmation with an institution to fix in a P&I owner-occ rate for a client at 2.05% fixed for 3 years. And he's also mentioning that he's now getting opportunities with lenders, majors, so with the big four, at fixed interest-only rates for investors under 3% now as well. So it was just very interesting to hear those numbers and really doing some very, very quick back-of-a-napkin math on fixed interest-only rates for 3 years for investors who are holding assets at, call it 5% gross. It doesn't take your listeners too much time to figure out what that means for cash flow and assets. So it's pretty amazing to figure out what this actually means for cash flow over the short, medium, and potentially long term, and probably where it points towards where the intention of investors will be in the coming months once the dust settles and people are more confident in getting back into that market. Because I'll tell you what, you can start doing the math on your own portfolio. If you shave off an extra percentage point of fixed interest only rates, you can see clearly that you're going to have thousands of extra dollars injected into your annual portfolio income on a weekly, monthly, and annual basis. Yeah,
I've got some time set aside this week, Paul, to go through the smart property investment portfolio and just look at how those numbers are going to change over time. From, we talk a lot about it on smart property investment. Well, they cost us a few bucks because there's so many properties in it. I don't know, by memory, it's about $2,500 a year per property, up to $3,000, depending what it is. Like, in many ways, it's going to equalise it out and potentially put us in a neutral position, right?
Yeah, exactly. I mean, I'm doing a massive refi. I was talking about this earlier today, but I'm doing a massive refi on my whole portfolio. And one of the big reasons why I've been intentionally want to keep it variable for the last couple of years is that the money markets haven't really found a common ground. And as much as it was probably looking like they were going to find some only a couple of weeks ago, this has now thrown that all into turmoil. And we're probably looking at a new norm again, which is bringing down those rates. But I'm looking at it from my side of things, taking, I've got literally millions and millions in debt sitting out there in the ether personally. And I know that, look, that's going to probably show it's going to give me an extra income position of anywhere between $30,000 and $50,000 a year just by some clever money moving over the next month or two. And for anyone who's looking at investing in property, I mean, these are the things that turn portfolios from negative to positive, or from positive to literally passive income, sustain your lifestyle income type of scenarios as well.
That's really good. So this is to the point around what COVID-19 is going to mean for existing property investment owners. Now, this is going to be one of the key outtakes about the changing of the cash flow in your portfolio and how you may be able to use that money. You might want to park it, you might want to use it for a rainy day, or you might want to. So, I always say, when's the best time to be in property? It's when you can afford to be in property. And if you are in the market right now, there's got to be cash flow ramifications of COVID-19. So recommendation would be do your numbers, have a look at the portfolio, see where you can start making more informed decision. Now, we had a lot of questions around this today, Paul, in our podcast. That's, I guess, one of the positives of this particular market and the shaving of interest rates. And I think we're moving into a long-term, more so than what we're talking about even beforehand. When you look at the wider macro market data, it is an economy domestically and globally in a state of flux right now. The Aussie dollar's probably the lowest it's been in a decade. Pressure coming on our domestic businesses. People are talking about, the emergence of China out of COVID-19 and how Australia will benefit from that as that economy gears up. But the big question that we had today, Paul, was around whether or not we're going to see drastic drops in property prices. And this is a big concern for investors right now.
Yeah, and I think, look, there's going to be some, I've had, 6 discussions with clients today already about pretty much these exact same questions. And I think there's going to be markets which will undoubtedly suffer from what's happening. And I think the markets which are probably least prepared for what's happening right now in this black swan event, ultimately, which is what's happening, unpredictable event, is the markets which are single economy focused, and those single economies were the first and probably will be the hardest hit. And that's essentially the tourism sectors, essential services, hospitality, and markets which are a whole lot more reliant on that. And that might even be things like the tourism holiday industry markets. And that's the south, north coast of New South Wales. That's the north coast and parts of Queensland. That's going to be markets that are in those more bayside. And even if you look at the Great Ocean Road side of Melbourne, Victoria, these areas that are all very, very predictable to see which ones will suffer the most and the quickest. But there's going to be markets which have got very robust economies and ultimately very robust, multifaceted markets which are going to rebound quickly when the economy does turn that corner. They're the ones who will probably turn a corner very quick and will be able to come out of this. But look, I do feel for the markets that were affected by the bushfires, to be perfectly honest with you, because that was probably a market which definitely needed the rebound of what was happening and what was going to hopefully come out of a good holiday season into the Easter break. And that's the east coast of New South Wales. When you look at South Coast as well as parts of the Gippsland region of Victoria, they're markets which I do believe right now are probably going to suffer and suffer very, very drastically. So they are markets there that, look, if you're invested there, if you live there, I do feel for you, but I would expect that they're probably the types of markets that, given what's already happened and given what is now happening as part of this, they will suffer and they will see the double-digit declines very quickly.
And one thing when it comes to property investment, as you know, Paul, as a property investor, but also as a professional that works within this space, one thing you are guaranteed in property is that markets will change, markets will move. You have no control over that. What you do have control about is how you react to that. Hence the reason why we like doing this podcast, hence the reason why we did that live stream today. So we'll keep covering it, keep conscious on it. What's the overall sentiment of your clients around the market right now? Is everyone jittery, or is there a sense of, wait and watch and see and then act?
Look, it's probably, if I was to assess 50 clients right now as an arbitrary number, I'd say that realistically 60 to 70% of them are, look, I just want to have a look at what's happening for the next couple of weeks before I really figure out what I want to do. There's then probably another 10 to 20% who are, let's get busy right now. And they're the ones who have got assured incomes as well as borrowing capacity ready to roll and really good positions fundamentally. And then there's probably another 10, maybe 15% who are out and out saying, I just want to sit on the sidelines for another 4 to 6 months and literally do nothing. So there's a snapshot that's going to go across the board, but majority are probably, look, let's just pause for a second here, see what this means for both my income as well as the market. There's a small portion who probably are saying I'm just out for the next 4 to 6 months. And then there's another portion that's probably a little bit bigger than those who are looking at it saying this is the best opportunity I think we've ever seen. So let's roll.
So what's your recommendations for investors at the moment? Is it just gather information, don't rush, don't think you're going to miss some opportunity? This has got some time to play out.
Yeah, agreed. I think that's probably a big part, is that A, don't rush. And B, I also think on the flip side to that is that people who think they're going to wait 12 months to go and find the bargain of a lifetime, the best probably the advice I could give and have been given in previous times of these types of cycles as well is these dips typically happen quickly, and the old adage of down by the elevator, up by the stairs scenario will exist. And I think we'll get to the bottom quicker than when we get back to the top. But I think we don't expect that this will be something that'll play out for years and years and then we'll find the bottom in 2023. If people are going to be looking at investing, I'd say gear up, get ready, but be prepared to make sure you can take action in the next 1, 2, 3, 4, 5, 6 months, because that's probably going to be, as time will play out, the best times to actually make the best of it, because money's going to be cheap for a long time. And when things do rebound, the money's going to stay cheap for a very, very long period of time as well.
I think there's some really good graphs and charts going around right now, and we'll stick them up on smartpropertyinvestment.com. There you go and check them out, which just gives some sense to markets and how they move. And like, this is a generational circumstance here. This is maybe 1 in 100 years a circumstance where we are right now. So, this time, COVID-19, we locked in history as a time which fundamentally changed the way things are. But if you go back to some of the other key events over the last 100 years, 150 years, and how markets have operated, it always goes north. It is always going north. It is tracking north, and we'll share this information. But you see these times of mass change, whether it was World War I was a time of major changes shaping the European and the global markets. The Spanish flu was another time. You had the Great Depression. You had World War II. And now we're moving into the big events like COVID-19. They do change and shape markets, but fundamentally, if you look at history, 150 years plus of history, the market starts going north again, right?
Absolutely. I mean, and this is what I think we talk about history that's going to show ways that we can learn from the past. I mean, if you take any lesson from what's happened in any event over time across the world, across literally decades, if not hundreds, and then going back to thousands of years, is that the market trends north. This is what happens with the market is pick your time, but, ultimately we've only got a certain amount of time in the sun, each one of us, and you've got to make sure that you do make the best amount of opportunity from the time that you have. So I think delaying too much is going to be detrimental. I think acting too quickly for some who aren't necessarily doing all their math on their positions potentially also going to be detrimental. Having a good team around you of people who have probably seen both sides of this ledger over a period of different downturns and upswings as well is probably really important right now, and probably more important than ever is surround yourself with a couple of people who have been there before, whether that's your buyer's agent, whether that's your accountant, whether that's your broker, whether that's peers who have invested in different times at different stages and through different levels of success. But I think picking their brains right now and trying to get a bit more of a general consensus. But for those investors who are already in the market, I think the biggest thing that those people need to really understand here is that this is a period of time, but this period of time is also going to mean that your finances and your cash flow is going to get better as a consequence. So they're the people who truly need to think about holding their nerve for the time being as well, because times will definitely improve from a cash flow perspective, and over the long term, times will improve from a capital growth perspective.
Yeah, and I've looked at some numbers for JP Morgan Global Economic Research 2020. So there's a whole bunch of new data coming out right now. This is talking about the impact of coronavirus on global real estate GDP forecasts, right? And prior to corona forecast was a bit of a spike from late 2019 into sort of the mid-2020s. What it's showing now is a huge decrease. Negative GDP down to globally about 1.5%, but it's forecast a significant spike subsequent to it in terms of GDP growth up over 3+%. So, this goes towards your elevator downstairs way up analogy.
Correct. And I think that's it. So is it talking about, so just to confirm that data from your side, Phil, is that talking about the fact that they're talking about a downturn this year and then a mass rebound next year and beyond? Is that where they're looking at from
I think they're calling there'll be GDP growth at the back end of this year.
Right.
Once they understand what's happening. But it is a sharp drop.
Yeah.
And we'll share some of these numbers. Well, there is literally so much information around it right now. And if you're a money market type of person, you can bury yourself in all this information. Now, the reason why I say that is that, I've got hundreds of graphs in front of me around potential credit tightening, potential GDP changes, the way in which financial institutions are going to be securing money and at what rate. There are so many at the moment around all of this that you can fall into the trap of being over-informed. And I want to touch on that, but we'll just go to a break beforehand. Back in a moment. Welcome back, everyone. Phil Tarrant here, host of the Smart Property Investment Show with Paul Glossop. He's director at Pure Property Investment, which is a property buyer strategist. That's the right description for you, Paul? So what you do?
Yeah, absolutely. Yeah, well, we are the reigning buyers agent of the year. There you go. Let's go with that.
It wasn't supposed to be a plug, mate. I was just trying to let
every opportunity I can get.
Just trying to let our audience know. But before we went to the break, I was explaining about how you can bury yourself in market data right now. And unless you're an economist or financial analyst, a lot of it won't mean enough. But you need to know enough to make informed decisions, but you don't need to know too much so you confuse yourself and you just can't make a decision. Do you agree with that consensus?
Absolutely. And I think fundamentally what I'm looking at personally right now is to think about what I've done in the past that's given me success for my own portfolio. And I'm looking to going to emulate that again over the next 3 to 5 years. And if anyone's thinking that they've got a secret recipe that's going to mean that things are going to be completely different and they're going to try to find a way to make different money in the property market over the next 2, 3, 4, 5 years, they're typically the ones that are going to have their fingers burnt, unfortunately. So I think don't overcomplicate it. Figure out why, how, where you should be investing and go and execute on things that have worked in the past, and that will consistently repeat that formula for the future.
So what are the things you can control right now? And there's a lot outside of your control, and you can be informed about it and you can look at the data and the markets. What you can control, Paul, and I know having read your book, another plug, The Surface Guide to Property Investment, you write about this, Paul, is that one thing you can control is your positivity. And one thing you can control is how you choose to move forward. There's a huge opportunity right now for property investors. Yes, there's a lot of uncertainty ahead, but there's also a lot of opportunity ahead. And listen to or read of some of the best investors in the world, and I think of Warren Buffett. This is points and times where he would be saying, with caution, obviously, that in times of crisis, in times of change, is where the opportunity.
Mm-hmm. No, unequivocally. And I think those who pivot and think probably a bit more broadly here and think, well, what's going to happen after this has all been found out? What's going to happen at the end of this when the economy returns to normal? The essential services are back open and running. The construction sector goes booming again. We've got governments that will tip money into huge amounts of infrastructure. We've got low interest rates. We've got fixed rates that are cheaper than they've ever been in their lifetime. So where and what are going to be the opportunities once that is all obvious? And then go and actually take action. They're the people, and you see them over and over, is that, and I guess the biggest key I see when we look at those traditional money mentors that sit there that are larger-than-life characters of the Warren Buffetts, the Australian Harry Triggerboffs of the world, they've been in the game a long time. And they have the experience of saying, look, I went through this downturn, I went through this downturn, I went through this downturn, and on the back of that downturn, here's what I did, and here's how I came back stronger, and here's where my empire went from that point. Or here's how I educated other people to how to create wealth in a certain period of time. But ultimately, the two things is that they're pragmatic, they take action, and they stay in it for the long term, irrespective of whether it's the equities market or the property market.
Yeah, and as tough as it is right now for a lot of people, this is just part of your story. It's how you choose to navigate through COVID-19, which is going to determine how you look at the end of it. This is about controlling how you think about stuff. You've got to make sure you choose what to focus on. If you go into social media, all you get is doom and gloom, negativity, and that's not saying that it isn't a tough market out there. It's not a tough time out there for a lot of Australians. And you only need to think back to some of the photos I saw in the paper today. It was reminiscent of the Great Depression with everyone out of work on the Hungry Mile. It's unprecedented. No one would have ever thought that we'd be where we are right now. But looking at the opportunities as property investors in this market ahead, looking at history and taking, and I'm a student of history, as you know, Paul, taking our lessons from history, what you choose to do now, how you document decision-making, to your point around these big money mentors about how you're going to look in the future. And you need to be self-reflective about this.
Yeah, agreed, mate. And I think you touched on a good point there, Phil, that you are a student of history, as much as I give you grief about it over a beer from time to time, but you probably know better than most how things have fallen out from big events across the world at certain periods of time, not just in our lifetime, but prior to, and ultimately what happened for economies in general to come out of those. And I think going back to touch on the fact that this isn't a cyclone, this isn't a mining downturn, this is a global health crisis. And the fact of the matter is that every single person in the world today is going to be affected by this at the same time. That's the thing that's also unprecedented, because what that means is coming out of this, everyone's going to come out of it at the same time. So it's not a woe is me scenario, and ultimately everyone's going to go down together, everyone's going to come back up together, and it's those who choose to take action, I think, in the short term, who are the ones that are going to come out of this above where they probably went into it in the first place, because has been no event in history that we can see clearly that we all went through it as a nation as well as a globe at the same time, to then say, okay, now we figure out we can all get out of it, and things will literally turn around altogether. And that's going to be the absolutely amazing thing, is that there will be a day where everything reopens. And when that day where everything reopens, you're then going to have sentiment literally within a day change. And then all of a sudden we're going to see the sentiment and where everything was in early March, where everything was rosy and we saw a property market booming and we saw an economy that was ticking along nicely and the most desirable place to live in the world was Australia. That will become exactly the norm again, literally within a day. Now, when that day is, look, it's hard to figure that out just yet, but that day will come, and it won't come in too distant future.
Yeah, and, again, turning to history, where we are right now, it's not going to get easier from where we are right now. It's going to get harder. Period ahead of it is going to get tougher, and as property investors, we need to make sure how we're going to navigate that and best position ourselves so we can do. But if you look at the Spanish flu or the 1918 flu pandemic, it lasted nearly 2 years. It affected 500 million people. Now, that was at the back end of the First World War. There's a good reason why they called it the Roaring Twenties. It wasn't because people were just out getting pissed every night in nightclubs.
There's probably a bit of that, let's be fair.
There was a fair bit of it, right? It was a time of change. It was coming off the back of the horror First World War and then the Spanish flu into a new economy. And, let's look at Australia right now. Australia, I'm proud to call myself an Australian, as you are, Paul. What a great place to live. What a great place to be a property investor. What a great place to be a business owner. It's hard to find a lot of negativities out of living in Australia. And sometimes you've got to check yourself when you start, complaining about something small, first world problems. I think probably that mindset's got to change quite a lot moving forward. And I think as people, we're going to be a lot tougher. And I think, hopefully, rather than being based on who we are as a nation, we are starting to think more like humans, and we are borderless in many ways. So, but looking at the Australian property market, the next decade looks pretty damn on the numbers I'm looking at from my reading of it, and a lot of the stuff that I've been hearing recently. We touched on it today in Bernard Salt, the demographer, and some of the work that he's done with us recently. I want to have a chat about that, Paul. We'll just go to a break beforehand. We'll be back in a moment, chat about the Australian property market. Welcome back, everyone. Phil Tarrant here, host of the Smart Property Investment Show with Paul Glossop, Director of Pure Property Investment. We chatted quickly before the break, Paul, around Bernard Salt, the demographer. Most of you know about him. He was famous for his smashed avocado thing. It was a huge ruckus with the millennials of the world, pretty much saying, if you want to invest in property in Australia or own a house in Australia, you got to make a few commitments. You got to make a few sacrifices. Well, I think the world's used to making sacrifices now, or they're going to get used to it. But fundamentals on the Australian property market, Paul, and we'll do a quick sort of round the ground, not too much time, but what's happening across the nation, because a lot of the questions we had on our live stream today is connected with it. We didn't get around to it, but immigration is still a big driver of urban growth and property demand. That's correct.
Yeah, absolutely. And I think that's something that's probably going to get stronger as a result of what's happening right now globally. Short term, obviously, there's going to be a hit to that with borders being closed. But I think once and if, that's going to be a very, very short blip on the radar. And I expect that we're probably going to be somewhere between 3 and 6 months away from all of that roaring back into more demand, and ultimately that 220,000 people who migrate to Australia right now is probably going to increase exponentially over time. And going back to that, going back to Bernard Salt's data, the fact that we're currently already about 30 or 40,000 properties a year short of where demand actually sits, I expect that over the next 3 to 5 years, that's only going to exponentially increase due to the fact that we're probably going to build less in the next 12 to 24 months. And we're going to have more demand from migration and natural births and deaths over the next 24, 36 and 48 months ongoing.
So let's have a chat around other states. And again, I've spoken about this before. I get a bit of flack from our audience about not always covering all of Australia. Well, I do concentrate on the major capital markets. It's where most of the activity has. And when we do talk regional, we talk regional. But, Sydney and Melbourne and Brisbane to a lesser extent are the main markets. So it's always a focus of our commentary. And I'll start in New South Wales. We can get that out of the way because that's typically where I caught most of the flack, but it is a huge market. Bernard Salt, some of the stuff he's been saying recently, New South Wales will continue to prosper, driven a lot by students and migrants. Now, that student thing might change a little bit in the short term. It'll continually shape the mortgage market and how we go about doing so. New South Wales economy leads the way with migration, infrastructure spending and business growth. It's evolving, it's changing. Australians are obsessed with lifestyle, with property and with the idea of a fair go. We will continue to work, we'll take risks, we'll acquire debt. And for many people, Sydney or the greater Sydney area, even into Newcastle and Wollongong, is a great place to be. What are you seeing in Sydney, Paul? Because some of the questions we had today from our viewers on our broadcast was mainly around what's going on in Western Sydney. What do you like there? And is there going to be expected property price falls in Sydney this year?
Well, if I take this year necessarily out of the equation, I think it's still too early to call what's going to happen in the short term as far as drops are concerned. But if we look at Bernard Salt's comments there on the Sydney and Greater Sydney market all the way up to Newcastle and then down to the Illawarras, etc., is the fact that we've still got close to $100 billion in infrastructure that's to be spent in the Greater Sydney Basin over the next 6 years. And that's from highway extensions, that's from West Connects, that's from the Aerotropolis precinct, and that's from everything else that's going on with the new Metro link as well. So we've got huge amounts of already paid for, already approved infrastructure that's going ahead. And the thing with downturns from an economic perspective is that it's going to push more people into these larger costed funded jobs. So we're going to see even people in the fringes or people out in the more regional markets who potentially are going to suffer from being in the position of very much low employment. They're going to push harder into the major cities, including Sydney and probably above all Sydney, due to the fact that the next 5 years and beyond looks very, very good from a jobs creation. So if we do see a small dip in prices, I think it's going to return quite strongly over that 5 year time frame due to the fact that we've got big jobs creation and we've got a very limited pool of supply that can be created just due to the natural ocean, rivers, national parks and mountains that we've got surrounding the whole metro basin.
Yeah, look, it's a tight market and there's not too much more to be built. There's obviously still a lot of house and land stuff going on there, but it is a great place to live. And some of the levers available to the government, whether it's a state government or federally, what they typically do in times of an economic crisis, and obviously this health crisis has turned into an economic and largely a financial crisis, is that they look at state-based or federally based infrastructure spending. You know, the Harbour Bridge was built in the 30s, right, at a time of the Great Depression, and that was a great way to get people in the jobs, plan for their future, and move forward. So you're going to see maybe some of these projects being deepened or even accelerated. The New South Wales job market is mainly skewed towards knowledge workers in many ways. Between 2000 and 2019, so to say 19 years, 225 new jobs were grown during that period of time. There's a lot of these infrastructure projects underway. You mentioned some of them. So how does that translate into where you start buying property? Should you be looking at, you know, the basic tenets of investing where there is infra, or is it largely there's so much going on that most markets should be positively affected?
Yeah, look, I think it's probably investing in markets. It probably doesn't change from where we were to where we are going. But I think if anything, people want a surety, they need to invest in markets which are going to see pretty much a surety of where jobs are going to go over the next 5 years. And if it's a bit of a coin toss and you're thinking about, there's this one thing that I thought was going to happen, whether it be a new mine or whether it's going to be a new resource or whether it's going to be a market that's going to see some random gentrification. I mean, I take into account, let's look at markets such as, hypothetically, Byron Bay right now. That's a market that is highly, highly priced as far as a lifestyle market that pretty much is in lockdown right now. And a lot of property, high-priced property in that market, granted, is owned by very wealthy people, but it's also vacated very regularly by holidaymakers. And in the short term, that's a market that's going to suffer hard and that's going to suffer from cash flow. A lot of people have life set up there from an income perspective, running Airbnbs and types of income investments, which just aren't going to exist for the next few months. Full stop, that's wiped off the board. So there might be opportunities in those types of markets for the short to medium term. And there are also markets which are highly probably risky and somewhat volatile in times of crisis. Byron Bay is probably a bit bigger, but then you go further north to the markets such as Cairns and over towards, you look at markets down the south coast of New South Wales, north coast of New South Wales, markets which probably just look like too volatile right now, which I just personally wouldn't see too much confidence in the bad times, and hence why we don't necessarily invest there in the good times, because the markets which are tried and trusted are typically the ones which have jobs creation assured in these types of situations.
Yeah, and I may have got those numbers wrong in terms of New South Wales job market. I will publish all this stuff on smartphoninvestment.com. There's about 1.2 million jobs. Victoria, mate. So let's answer that question we had quickly around Western Sydney. What do you like out there now? I know you've got some property out there yourself.
Yeah. Look, if I'm holding for 15 years out there, which I am absolutely, and I've got multiple investments out there, as I know you do as well, I'm absolutely comfortable and confident. And one thing that's going to change as of July in the New South Wales market is, if anyone's been following some of the changes to the LEPs across New South Wales over the last 2 or 3 years, or the proposed changes to R2 dual occupancy, as well as a host of others, including manor houses and dual occupancy, in addition to multi-res tenancies, there is going to be the change to R2 600 square metre, 15 metre frontage properties that are applicable for duplexes are going to end up going down the pathway of compliant development. So we're going to have opportunities down the track to fast track applications for development in the coming 12, 24, 36 months right across New South Wales. So if anyone hasn't got familiar with those LEP changes, jump onto the New South Wales website, New South Wales government website for development, and you'll see the proposed LEP changes for what is deemed to be what was previously a full council application, and call it 6 months in the council to get a result, which will end up being a 2 to 4 week compliant development with the private certifier to allow things like construction of duplexes or manor houses, which is a 4-packer units in R2 zones, or even multi-res dwellings in areas which are R2 on over 1,200 square metres. So there's going to be some scenarios there that'll change. So if you're holding land and you're holding areas which have got really good opportunities for consistent growth as far as population, then I expect that the next 10, 15 years will look very attractive.
So, we're talking about job growth here as one of the metrics for showing long-term prospects for the market. Since November 2000 in Victoria, 1.28 million jobs grown, again, mainly around knowledge workers, so healthcare and social assistance, professional services. How do you feel about Melbourne at the moment, mate?
Yeah, look, very similar to the Sydney market. I think it's there, it's positioned well, and it's going to be that way for some time. The biggest difference, I think, probably over the medium to long term is possibly the fact that there is a lot more available land in the west and southwest of Melbourne, and that can't be changed. So you got towards Melton, up towards Werribee, and over to all the way through to Ballarat and Geelong. The inability for them to probably put a cut to where they can keep building. There is a lot of available land that'll keep being released to house and land over that time. As much as the demand's there, I think the middle rings that are already better positioned of the Sunshines, Altona in towards places like Footscray, etc., are probably going to see better positioning for those middle ring markets, which will gentrify better over time and have already got the good infrastructure.
Yeah, and before we get on the Queensland, there was a question here, and often we don't cover it. It's a question today, can you cover Canberra property market, please? What are you seeing down there?
But I think it's been really quite consistent. I mean, if someone chucked money into that market, $500,000 as an example 5 years ago, they've seen consistent 5% compounding for the last 5 years, which is good returns, and yields have been really quite attractive. Vacancy rates have stayed quite low. They had the whole Mr. Fluffy issue of the asbestos that came out of over the last couple of years, which ended up in about 1,000 odd properties being bought back. But look, that was probably a bit of a sensationalising on the media side, thinking that was going to be a disaster for the market there. But all that's done is basically made the supply tighter because there's less properties available in the market. And there's still some issues with supply in the townhouses/apartments, but freestanding houses in that market, as well as what we're going to go through from government employment being a lot more assured, that's going to be a pretty stable market, I think, for the next 3 to 5 years, as we're all going to come or find the outcome of what happens from the economic downturn, and a lot more emphasis on government jobs and more focus on people wanting to get into that sector.
And I imagine it's probably consistent with Queensland. You're quite active up there. You've got a lot of property personally, but you do a lot of active buying for your clients. You're mainly into value-add unique assets up that way. And you look at there's a lot of interstate migration. We chat about these economic fundamentals largely haven't changed because of COVID-19. Yes, they will be impacted for a period of time, but I think the inherent drivers of the Queensland property market will stay pretty consistent. A lot of sea changes. There's also, I guess, a lot of migration as well. Since November 2000, I had about 900,000 jobs created. So stuff's happening there.
Yeah, exactly. And I think that's the thing that people need to forget, or people rather forget too quickly, is the fact that there's a lot of jobs being created now and supply is really dropping off. And that's the big deal in that market, is that with the jobs creation and the lack of supply, they're going to see the same downturn that everyone's going to see from a short-term impact here. But when it comes out of the wash of where we're heading down, and when we come back up, the fundamentals of where the actual jobs creation and the larger infrastructure jobs are coming and already are, they're not going to change. If anything, there's going to be more money behind them to get more people back to work in those markets. So, look, doesn't change. I think value-add opportunities in those markets, there's really good opportunities in that market, I think, for people to look at both good freestanding houses with value-add opportunity that are still providing 5-ish% gross yield. And as we talked about earlier, with 3% fixed interest rates for investors, if you're getting 5% gross, I can almost guarantee if you're borrowing 105% of your money, you're going to be positively geared by probably somewhere between $2,000 and $4,000 a year on that asset. So if you're playing a long game, you're in a very, very sound position.
Yeah, when you look at a lot of these job growth that has happened, by and large, healthcare and social assistance is the primary area. And I think a lot of that's got to do with, healthcare in Australia and also an ageing demographic. But number 2 and number 3 job growth is around that construction industry, which gives you a bit of a clue for how the state governments are spending their money and associated infrastructure and development. Quick check-in down in Adelaide, Paul, South Australia job market. It's growing. It grows at a different speed in terms of absolute numbers compared to the rest of Australia or the East Coast capitals, but it's still pretty strong. What are you seeing down there?
Look, I think it's going to be pretty much steady as she goes. I don't see that it's going to look any better or worse than it did only a month ago, before we were even talking about COVID-19 and where that reflects on the markets across the board. If we look at the shorter term data up to March this year, it was pretty flat in the Adelaide market up until the last rolling 12 months. When we're talking average house prices, depending on what data you're looking at, between $450,000 and a bit over $500,000, you're probably talking very low vacancy rates. So you're getting half decent cash flow on your money. You're getting very little supply coming to that market. Jobs creation stable, and I don't think that'll change necessarily over the short to medium term. So I think it's going to be a market that will pedal along nicely if we look at it from a 3 to 5 year perspective, and vacancy rates are tight to start with.
Yeah, and we'll finish off. We speak a lot about Tasmania, and I think we'll leave that for today, mate. But there's a question that we received today around Perth And that question was from Sean. He said the Perth market is already at the bottom. Does this mean it will be the quickest to recover as there is less amount to fall? And no investors are really active currently is what he says. What's your thoughts?
Well, I'm active. So, but I look at it and say, look, yeah, we can say that the markets that are at the bottom are the ones that get less to fall. But if a market's at the bottom, then it probably needs more momentum to start moving. And further setbacks only then typically can impact those markets even more or stall it further. The good thing about the Perth market in general, the reason why we're somewhat active there at this stage is the fact that there are some big federally spent infrastructure projects. So again, federal money, state money that's already backed to create jobs and create big infrastructure. The Perth MetroNet project is about a $3 billion project that runs from Perth Airport at High Wycombe and Forestfield into the CBD. And that's a project that's going to deliver a lot of jobs and also going to connect that market in general over the next 5, 10, 15 years. And looking further afield, that's a market that's trying to probably get more access to the Asian money and Asian education as well as tourism sector. So I think one thing that will happen from that market is it will become consistently attractive and more attractive, and cash flow is quite good there. We're seeing vacancy rates drop below 2.5% on almost every market, and that's going to be a consistent theme. So cash flow is good, vacancy rates are low, supply is very, very low comparatively. And once that economy turns a corner, it's looking very attractive for us in that sort of $300,000 to $500,000 market.
Sounds good, mate. Well, I think we've covered a lot of ground there. Thanks so much for joining me and having this discussion. And I much prefer to be in person, to be honest with you, in the studio. It's, it's still okay, though, over the marvel that is the interweb, right? It's not too bad doing it this way, but I look forward to getting back in person in the studio with you, mate, to keep chatting about all these type of things and making sure our listeners on Smart Property Investment Podcast are highly engaged and connected and know what's going on. But thanks for your time today.
No, I appreciate it, mate. And yeah, look, I do prefer it in person most certainly because I get my fix of your pinstripe suits once a quarter when I do see you in person, which I just don't get anywhere else in the mall. That was sort of 10 years ago. I used to see a lot more of it, but yeah, I do see it a lot more when I'm in person with you. So.
Well, did you notice on our live stream today I dressed down and I didn't actually have a suit jacket on?
Yeah, I did notice that. It was a little bit unbecoming of you, I thought, actually. I don't think your audience really would have appreciated it, to be honest with you. But look, nonetheless, that's your choice, mate.
To be fair, though, Paul, I am a journalist, so I'm supposed to be pretty scruffy.
You are. You're probably a little bit too well kept.
Maybe I can work on that. A little bit more.
I don't think it'll take you too long. Somehow, I think you give yourself 6 hours and you could come back. There'd be raccoons on your desk and all kinds of things happening. Burger King, half-eaten chips, whatever you like. Yeah.
Well, let's see what happens now where everyone's social distancing. And anyway, we'll get back to it. But our commitment to our listeners, if you're tuning into this right now, we're going to be, it's business as usual for us from Smart Property Investment. Now more than ever before, it's important that we are highly engaged and connected. A lot of you are going to be working from home. You might be a bit lonely. It can be a challenge working remotely and you haven't got the connectivity of human involvement. So tune into us twice a week. We'll be doing our podcast plus a whole bunch of other things, particularly on the live streaming. So you can keep involved, you can keep engaged and keep tuning in, and we'll make sure we do the best we possibly can to give you the information you need so you can make more informed investment decisions. Paul, you'll come back for a Q&A at some point.
Absolutely, mate. I can't resist your dulcet tones and I will get lonely without hearing your voice.
No, very good. Nice one. And I hope you enjoyed that, everyone. Any questions at all, we'll put some of these numbers up on smartpropertyinvestment.com.au. We got through a lot of those questions that we didn't get a chance to cover on the live stream. So thanks to everyone that got involved. Remember, you can go and watch that live stream right now. It's not so live, but it's just going to be online. If you just click on the webcast section on smartpropertyinvestment.com.au, put your email address in and it'll open you up into that live stream, and you can also watch all the other ones that we've done. So great source of information. Go and check it out. It's all free. It doesn't cost you a cent and you can be more informed. Any questions around this podcast or even a live stream or anything we're doing in general, you can contact the team editor at smartpropertyinvestment.com.au. Remember, every single morning we are delivering market intelligence and news to you. So the first to know what's happening in property right across the nation, particularly right now with COVID-19, you can subscribe there at that website, smartpropertyinvestment.com.au. If you get your info from social media, it's Property HQ. Please, if you like what we're doing, please keep those reviews coming whichever past player you're listening to this in. The team get a real kick out of it now more than ever because we're not getting together. So we are all remote. We're recording remotely. And I trust this audio is of the standard which we would expect. And it sounds pretty good to me. So we'll keep at it. I hope you enjoyed that. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.